Welcome to This Explainer. I'm Michelle. Before we jump in, I want you to just take a deep breath and imagine we're sitting down together right now at your kitchen table, sharing a warm cup of coffee. We're going to talk about something incredibly important today, and that's protecting the hard-earned equity in your home. Selling a house, especially that family home you've lived in and loved for decades, well, it's a huge step. But the financial side of it really doesn't have to be stressful at all. So let's just dive into this together. Now, this is absolutely the number one question on the minds of homeowners, especially if you're over 50 and exploring a downsize or maybe a transition to a new lifestyle. I completely get the emotional and financial weight tied to selling a long-held family home. It's a lot, but I actually have some truly wonderful news for you today. Understanding just one simple concept can save you from so much unnecessary worry, and it could potentially save you thousands of dollars. Section 1. The Tax Savings Secret. Good news for your bottom line. So the crucial secret here is that the IRS only taxes your profit, not your total sale price. To figure out that profit, we first need to find your starting point, which is known as your cost basis. It's really just what you originally paid for your house, maybe that was 20 or 30 years ago, plus a few of the closing costs you paid at settlement, things like transfer taxes or title insurance. It's just a very gentle, straightforward starting point. But, as you probably know, that starting number rarely stays the same. Over the years, it grows into what we call your adjusted cost basis. This is your original cost, plus the cost of any permanent capital improvements you've made to the property. And here is the beautifully surprising part. The higher this adjusted number goes, the less profit you appear to make on paper. And less profit? Well, that means keeping more of your own money away from taxes. Moving to Section 2, Improvements versus Routine Repairs, Knowing the Difference. Now, the IRS draws a pretty firm line between these two. Capital improvements are those permanent upgrades that add value, adapt the home, or extend its useful life. So think of putting on a brand new roof, maybe adding a bathroom, or doing a full kitchen renovation. These absolutely increase your basis. On the other hand, routine repairs, like painting a bedroom or fixing a leaky faucet, those are just considered general maintenance. They do not increase your basis. Because of that firm rule, keeping every single receipt for major projects is absolutely essential. I know, digging through an old shoebox of receipts from 20 years ago doesn't exactly sound like a fun afternoon. But trust me, it is incredibly worthwhile. Those faded little pieces of paper are proof of your investment, and they directly translate to keeping thousands of dollars right in your own pocket, exactly where it belongs. Section 3. The math behind the savings. How improvements protect your profit. Let's walk through a really empowering example. Let's say you bought your home for $200,000. Over the years, you lovingly invested $60,000 into it, maybe a new roof, an updated kitchen, and a really beautiful back deck. So your adjusted cost basis is now $260,000. If you sell the home for $500,000, the IRS actually subtracts that higher number. You just successfully shielded $60,000 of your profit from being taxed. And the news actually gets even better. Imagine a 30-year family home where you've made, say, $90,000 in qualifying improvements over time. When you combine that much higher adjusted basis with the Section 121 exclusion, which, by the way, shields up to $250,000 of gain for a single filer, your taxable gain could easily be brought completely down to zero, literally $0. Okay, Section 4, Rules for Inherited Homes, the step-up in basis. For adult children helping aging parents, or maybe for surviving spouses, this next provision is incredibly important. It's called the step-up in basis. Basically, what this does is reset the home's cost basis to its fair market value at the exact time of inheritance. This means decades of appreciation that happened during the previous owner's lifetime, they simply disappear from the tax calculation. Because of this really compassionate rule, heirs who sell an inherited property often owe little to absolutely no capital gains tax. Section 5. Next steps before you sell. Empowering your home sale journey. To start empowering your own journey right now, you'll want to begin documenting your improvements. Start gathering up your receipts, contractor invoices, and maybe old bank statements. And please, do not panic if you're missing a receipt from a remodel you did back in 1998. You can actually often go down to your local municipality and pull the permit records. Those records beautifully reconstruct the history of the care you've poured into your home over the years. Here is a clear, simple, 3-step action plan for you. Step 1. Gather up those receipts and permits. Step 2, go have a warm conversation with a CPA who truly understands real estate. And Step 3, speak with your senior's real estate specialist, or SRES, about timing. Timing your sale correctly is just so crucial because a large gain could accidentally bump you into a higher income bracket or even trigger an increase in your Medicare premiums. Now, I must gently remind you that this explainer is strictly for educational purposes. Every single family's financial situation is wonderfully unique, so please always consult a qualified CPA, tax advisor, or estate attorney before making any final decisions regarding your home. I really hope this information has brought you some clarity and peace of mind today. Selling a home is about so much more than just square footage, right? It's about recognizing the true value of the life you've built there. So as you look around your house today, ask yourself, are you leaving thousands of dollars of your own legacy on the table simply because the paperwork is hiding up in the attic? Thank you so much for joining me, and take care of yourselves.